Hey, in this video, I'm going to show you how we made $10,000 in 5 minutes time. Probably less than 5 minutes time. And you know how we did it? By selling covered calls. So if you want to learn how to use the shares of stock that may already be in your account to start collecting some extra cash, you're going to want to stick around and watch this video. So let's go. All right, everyone, Lee Lowell here from smartoptionseller.com. So what we're going to be talking about today is how to get a nice infusion of cash into your account by selling covered calls. Again, we have our cheat sheet here, the Smart Option Seller Guide to Selling Covered Calls. We're going to go over the basics of what it is, why we like to do it, and I'm going to show you some real examples of what we did. And we're just going to go from there. So let's just jump right in. For those of you that don't know what covered calls are, it's very, very simple. It's one of the most basic strategies out there, and most brokers, I'll probably say all brokers, allow you to sell covered calls as the basic level 1 approval level if you have an options trading account. So what is covered calls? Number one, it's a great way to earn some extra cash just because you have shares of stock in your account. But the caveat here is that you have to have at least 100 shares of stock in your account in order to trade covered calls, okay? So as we're reading along here, for every 100 shares of stock that you own in your account, you are allowed to sell one covered call against those 100 shares. Each option contract consists of 100 shares of stock. So obviously one option contract can cover 100 shares of stock. So what is selling covered calls all about? Well, let's just say you bought your 100 shares of stock down here and you want to collect some extra income by selling a covered call. Well, what does that mean? Well, what you can do is you can sell a call option up here, above the price of the stock, which would be the strike price. And what will happen is when you sell that call option, the call option buyer is going to pay you cash for the right to take your shares away from you sometime in the future if the stock moves up to that strike price level. Okay, so basically what you're saying here is that if you have 100 shares of stock, you're going to set a sell price for yourself sometime in the future at a much higher price than where you bought the shares to begin with. Now, by selling those shares or obligating yourself to potentially sell those shares sometime in the future, someone's going to pay you cash to do that. And so what's going to happen is that you're going to sell a call option at a strike price somewhere above the price that you bought the stock, and you're going to get cash for that. And hopefully what the best goal is that the stock moves up but doesn't reach your sell price, because that way you can end up keeping the shares, the option will expire, and then you can repeat the trade, okay? So let's just look at it this way. Let's just say you bought shares of stock at $100 a share, and you'd be okay selling those shares at $130. So instead of just putting in a limit sell order to sell the shares if the stock ever moves up to 130, what you're going to do is you're going to enter into a call option obligation. You're going to sell a call option at the 130 strike price, which obligates you to sell your shares at $130 sometime in the future, if and only if the stock moves above $130. So what you want to do is you want to set yourself up for a potential sale price that you would be comfortable with letting go of your shares. Now, as I said, the best possible outcome is that the stock price moves up but doesn't go above your strike price. So in this case, we're talking the $100 buy level, the $130 sell level potential. So as long as the stock doesn't move above 130, you don't have to relinquish your shares. If the stock gets up to 129 and expires on that day, you're still good to go. You'll keep your shares, you'll keep the money that the call option buyer paid you, and now you can sell another call option, another covered call, for another expiration date at an even higher price now. Okay, so let's just go through some of these things, and then we're going to look at a real example here. So as I say, if you want more upside appreciation of your shares and less chance to relinquish them, it's smarter to choose a higher strike price level. Okay, as we said, the $100 your buying level, $130 is your potential sell point. Some people may pick $110 strike price. That means they would only get, $10 of appreciation of the stock price. At $130, you're going to get all $30 of that stock appreciation, and then you'll have to sell your shares. Some people like to get out of trades quicker. Some want to hold on for longer, okay? Also, options all have different expiration dates. Going to scroll down here a little bit. The longer you go out in time, the more money you will receive for your call options. So let's just say, now it's August. If we sell a September call option, you're going to get, let's say, $1 a contract. But if you go out to December, you may get $3 or $4 per contract for those call options. So the longer time you give for the stock to potentially move, the more money someone will pay you. So keep that in mind, okay? And lastly, some people think, they bought the stock at 100 and they're going to obligate themselves to sell at 130. Then all of a sudden the stock starts trading up to 130. Like, oh my gosh, I don't really want to get rid of my shares. I don't want to relinquish my shares. Well, you can always get out of the trade anytime you want. How do you do that? You just buy the call option back at whatever its going rate is at that time. And when you buy the option back, it may or may not end up in a loss to you. So since you originally sold the call option, now you have to buy it back. If you buy it back for a more expensive price than what you originally sold it for, it would lock in a loss to you. But just remember, as the stock's going up, you're making money on your 100 shares of stock that you own. So any loss that you'll ever take on buying the call option back is going to be more than made up by the gain that you'll make as the stock moves up in price. So always remember that. And lastly, right here, this one's pretty important. You always want to choose a strike price to relinquish your shares above your cost basis. Okay, so if you bought the stock at 100, you're not going to want to sell them at $95. So you don't want to choose a 95 strike. Why would anyone do that? Well, let's just say 5 months ago we bought the stock at 100 and now the stock's down at $75 a share. So we have $25 of, a paper loss. And when the stock's at 75, someone says, well, maybe I'll sell a covered call at the 95 strike price. Well, if the stock rallies back up to 95, you have to sell your shares at 95. You bought them at 100 originally, you're locking in a loss. So you always want to make sure whatever strike price you sell for the covered call is at a level above your initial cost basis. Okay, as long as we're all clear with that. All right, so let's look at a real trade that a family member of mine did last year in 2022. Now, I made an earlier covered call video that I'm going to put a link in the description below, and I'll also have it on the screen at the end of this video. So you can click on it at the end of this video, or you can go down in the description and click on it there. But the trade, it was working on shares of Adobe. Okay, this family member of mine has 6,000 shares of Adobe long in their portfolio. Okay, so it's a lot of shares. So for every 100 shares of Adobe that you own, that this family member owns, they can sell one call option contract. So in this case, they have 6,000 shares. They can sell 60 call option contracts. So what this family member did back in 2022, and I'll show you the chart of Adobe in a minute, is that this family member sold 60 contracts of the January 2024 650 strike calls, and they were sold for $10 per contract. You have to use the 100 share multiplier. So 10 times 100 is $1,000. So this person in my family got $1,000 for each contract. 60 contracts, that's $60,000 of upfront income for the obligation to sell their shares at $650 a share. At the time, Adobe was at $425 a share. So it's $425 here. This family member was obligating themselves to sell their shares at $650. So it was a $225 move that Adobe would have to go up even before they would have to relinquish their shares. But the good thing about it is that you can always buy back the options, like I said. So in February of 2023, which was maybe 7 or 8 months later, the price of Adobe started going down, and those 650 call options were only worth $1 at that point. So what we did was we bought all 60 contracts back for $1 per contract. Okay, so that cost to buy them back $6,000, and in the end it turned out to a net gain of $54,000. And so if you watch that prior video that I'll put on the screen, you'll see how that trade turned out. So that was a net gain of $54,000. So let's pull up the chart of Adobe here. Okay, so here's the daily chart of Adobe, and the trade was initiated back in June of 2022. And Adobe, so it's right around here. Okay, so we can open this up a little bit. Right around middle of June, Adobe was around $425. That's when the you can see here's the symbol for Adobe, ADBE. The 60 contracts of the 650 calls, which was all the way up here, and Adobe was trading here, sold it for $10 a contract. And then as the stock started to trade lower, the call option values started to go down as well. And then right around February, sometime in February, those options were able to be bought back for $1 per contract, locking in the $54,000 gain. So now, just recently, so we're going to go over a little bit more on the chart, Adobe has now rallied back up again. And if we go back to the cheat sheet here, in June 2023, so just about 2 months ago, a new set of covered calls were sold. They only did 20 contracts this time at the 750 strike for those same January 2024 expiration. And those were sold for $5 per contract, or $500 per contract, which netted $10,000. So there's your $10,000 in just a few minutes time. Okay, so in this case, as Adobe stock started to rise, the family member wanted to have an obligation to sell the shares at a higher price than what they originally did. Back in 2022, they used a 650 strike. Now they're using a 750 strike. So they're giving themselves another $100 of potential price appreciation. So now if Adobe has to go all the way up to $750 in order for them to relinquish their shares, and they got $10,000 for their effort. Now, they have 60 contracts that they can play with. They only sold 20 contracts right now, but we're going to try to we're going to break it down into thirds. We're going to try to sell another 20 contracts of the 800 strike. And then if Adobe stock keeps going up, we'll sell the final 20 contracts at the $850 level for Adobe. All right. So at this point, Adobe's at $515 a share, roughly. We can go back to the chart. Adobe finished around $513 and change. So basically, here's the potential selling point all the way up here at $750. Adobe has to rally more than $200 a share at that point in order for the shares to get called away from this family member. So, let's just let me show you some more numbers here. Basically, what happens is if Adobe climbs all the way to $750, but not above it by the January 24th, 2024 expiration, those 2,000 shares, because we've only sold 20 contracts, the 2,000 shares will gain over $200 a share, basically, and that'll have a net gain or a paper gain of $470,000 for the Adobe shares that's being held in this person's account. And as long as Adobe doesn't close above 750, well, that person will get all this $470,000 of paper gains, and the option will expire. So we won't have to sell them at $750 a share. All right. So in a nutshell, selling covered calls can bring in boatloads of cash depending on how many shares that you have. All right. I want to make sure that everyone understands this. And just to show you, I want to show you the trade confirmation of the Adobe trade. So here, bring it up on the screen, you can see here's the trade confirmation. The person sent me a picture, so I apologize, it's not the greatest quality, but you can see right here, 20 contracts at a price of $505.10 per contract. It's actually $5,010 per contract. So that brought in a gross amount of $10,200. But here's the kicker. Look at these high commissions. I haven't seen commissions that high in like decades. So over $270 of commissions just to trade 20 contracts. That's highway robbery. You know, today's market, most brokers don't charge more than $1 a contract. This commission shouldn't have been more than 20 bucks total. But anyway, so here's the net transaction, just under $10,000, and you can see here it is, call Adobe. 750 strike of the calls expires on January 19th, 2024. Okay, so if we go back to the chart, you can see 750 is all the way up here. Got a long way to go before Adobe gets up to that price. So, you know, as long as if Adobe can, you know, slowly work its way up towards 750 by January, that'll be the best situation, because this family member, like I said, will make close to $470,000 on the price appreciation of the stock, and then they won't have to relinquish the shares as long as Adobe doesn't get above 750 by January. And even if it does get up to 750, let's just say Adobe gets up to 800, yes, this family member will have to relinquish at least the 2,000 shares at 750, but they'll make all that money, that $470,000. They'll make the $10,000, which they got from selling the options, and they'll just relinquish their shares. But you will always make more money on the price appreciation of the stock versus how much money you may end up losing if you end up buying back those options. Okay, as long as you choose, well, these are called out-of-the-money strikes. They're much higher. The strikes are much higher than the current price of the stock. So there's a great way to earn income off your 100 shares. Now, if you only have 100 shares of stock of, you know, maybe a $50 stock, it's okay. You know, just start learning how to do it. You may get $1 or $100 just for selling that one covered call option. You know, as long as you choose a strike price that's higher than your cost basis, you'll still make money. If you don't want to relinquish the shares, you know, go further out in time and you'll get more money. We can look at the option chain here. Let's look at our Interactive Brokers option chain here. We have Adobe pulled up. So I want to just show you what's happened here. Here's the January 2024 options. And here's those 650 calls that were first traded back last summer. So those were originally sold around $10 a contract, which is what it's worth about now, worth a little bit more than $10 a contract. When Adobe dropped, these options went all the way down to $1 per contract. And now that Adobe's rallied a couple $100, they're back up to $10 a contract. But we're not using those anymore. We're using the 750 calls right here that are currently worth roughly $3 a contract. Let me scroll up here a little bit right here. $2.83 at $3 offer. So they're worth a little bit less than $3 a contract. They were sold this time around for $5.10 a contract. Now they're worth, you know, just under $3. So even though Adobe stock has gone up, the option values have gone down. We sold them for $5.10 per contract. They're worth under $3 now. So you've got some time decay working here. Even though Adobe stock's going up, the call option values have fallen a little bit. Now, so we're waiting to see what's going to happen. If Adobe starts cranking higher again, then we're going to look to target these 800 strike calls, try to sell those for $5 a contract as well, bring in another $10,000 of income. So there you have it. That's the whole goal of selling covered calls, is to bring in income that you might not have never known about before. Between these two trades, the $54,000 net and this new $10,000, that's $64,000 that my family member made and had no idea they could make these kinds of trades. So if you have at least 100 shares or maybe a couple thousand shares of a stock, you know, you can look into selling covered calls. Make sure you use a strike. In case you get taken out, it'll be at a level that you be comfortable with. Yes, if you sell them, there are tax consequences. I don't want to go into that, but you know, any trade that you make and you make a profit, you're going to have to, you know, pay taxes on it. So, you know, talk to your investment tax advisor about that as well. Let's see if there's anything else that we want to talk about here. Yep, that's about it. So you can always rewatch a video and look at this cheat sheet again. So on the screen here, I'm going to put up the prior video that I made and an even older video that I made about selling covered calls. Down below in the description, bunch of links for some items that may interest you. Some books that I recommend, broker that I use, Interactive Brokers. You can look at some of those links. All right, so hopefully this video has been helpful to you. Give me a thumbs up, give me a like, leave me a comment, send me an email. We want to make these videos go viral, so the more likes and subscribers I get, the more that YouTube's going to start showing this to people. Don't forget to subscribe. Hit that red subscribe button in the bottom right-hand corner of the video as you see in front of you. All right, that'll do it. Let's quickly go to our website. Give me a second here. smartoptionseller.com. You know we are big proponents of option selling. This video we talked about selling call options, but what we do is we sell put options. Anyone that doesn't know what selling put options is, go to our website, click on the Put Selling Basics header right here, and you can get yourself a free copy of our Put Selling Basics ebook. Scroll down, put your name and email address in this box. You only have to do it once. This box is all over our website on all these other pages. You only have to fill it out once. Get a free copy. We'll send you an email with a link to download. If you want to learn about what else we do with the Smart Option Seller, we have a couple newsletters that we run. We sell naked puts and we sell put option credit spreads. We also have our coaching sessions if you need a leg up, you want to learn more, you want to talk to someone who's been in the business for more than 30 years, that's me, then you may want to look into our coaching sessions. All right, that's all for me today, and I'll see you here next time. This is Lee Lowell signing off.